The top business stories live from the Sky News City studio. Mixed news for the Chancellor as the government enjoys a record financial surplus for January, but it's less than expected. Record annual profits for HSBC despite an unexpected drop in earnings for the final 3 months of the year. Heathrow returns to profit for the first time since the pandemic. I'll be speaking with its new chief executive. And London's iconic BT Tower is to be turned into a hotel after being sold for £275 million. Good morning, this is Business Live with me, Ian King. The government enjoyed a record financial surplus in January thanks to a big rise in self-assessed income tax receipts and lower interest payments on the national debt. The Office for National Statistics said this morning that the government achieved a surplus of £16.7 billion during the month, up from one of £7.5 billion in January last year, but lower than the £18.7 billion the market was looking for. It means that during the first 10 months of the financial year, the government borrowed £96.6 billion. That was down £3.1 billion on the same period last year and some £9.2 billion less than forecast by the Office for Budget Responsibility. Well, that in theory should give Jeremy Hunt, the Chancellor, scope for some tax cuts in his budget on the 6th of March. The national debt stood at £2.65 trillion at the end of January. That represents 96.5% of GDP. Well, joining me now is Simon French. He's Chief Economist and Head of Research at the investment bank Panmure Gordon. Simon, good to see you this morning. Looking at the composition of the figures, it looks like the heavy lifting is being done by lower interest payments on the national debt.
That's right. The UK is unique amongst the G7 of having about a quarter of its debt stock that is index linked to the retail price index. And as that has come down from its very high levels, almost 14% just over a year ago, down to closer to 5-6% now, that actually is something of a tailwind for the public finances. And on a rolling 12-month basis, the government paid about £76 billion worth of debt interest. That's a big number, but down from its peak of north of £100 billion.
Yeah, I mean, the Chancellor really needs the Bank of England to start cutting interest rates fairly rapidly on that basis.
And he has started to tentatively get into that debate, hasn't he? He started to talk in the context of markets expecting interest rate cuts in the summer. Is that a little bit of political pressure from the Chancellor? I think he's dancing slightly around the handbags, but clearly would help in terms of the public finances if the risk-free rate and therefore the issuance of new debt as it rolls over and gets reissued comes at a lower interest rate.
What about tax receipts? I mean, January is always a good month because we get the self-assessment tax receipts rolling in, but the numbers are a bit shy of expectations.
They were, as you said in your intro, about £2 billion lower than the Office of Budget Responsibility thought. January is also always a volatile month, self-assessment, returns. I think if you break down the composition, there was a big increase in income tax receipts, up 11% year on year. Fiscal drag, of course, the freezing of the tax thresholds coming up very clearly in that data. Stamp duty down 21%, tells you the sort of still very becalmed nature of the UK housing market. But overall, receipts were up 4.5%. Might sound like a good number, but when you're indexing benefits at 6.5–7%, pensions at 8 and a bit percent, that becomes quite difficult to maintain the improvement in the public finances against that backdrop, which happens in April.
Indeed, and in pounds, shillings and pence, benefit spending went up by even more than tax receipts, which is not really great news for the Chancellor.
It isn't, and it just reminds us, although we get decent news today in terms of public sector borrowing, the overall deficit is still, well, it's going to be £110 billion for the year. That's still right on a knife edge of the fiscal rules, not just in year, but also on a 4 or 5 year view. So, yes, inflation has helped and the reduction in the interest rate costs has all helped. But the idea that there's in the round that this is now a very favourable public sector finances backdrop is just not true.
Yeah, so what does this all mean for the budget then? Is he going to be able to cut taxes?
Well, I think he does, but it's not based on the January data in the public finances. I think it is more the fact that in the round, the picture in terms of the economy, in terms of overall money that government has to subsidise in terms of energy costs, has produced a bit of leeway. We think in Panmure it's just shy of about £10 billion. That's not huge in a context of a public sector that spends about £1 trillion. But if you're looking for something eye-catching, what political pundits call the retail offer on tax going into the general election, then yes, there is something there if you talk about 1p of income tax being worth about £6 billion a year.
And a cut in national insurance would be what, £5 billion per percentage point?
That's right, that's right. So you've got the potential to do that. I think the real challenge really is for the Prime Minister and the Chancellor is they've talked very much about long-term decision-making, encouraging business investment. And if you benchmark the UK and its composition of GDP, it under-allocates to investment and over-consumes. So while something on consumption, i.e. a VAT cut or national insurance cut and income tax might be beneficial for the consumer, they may say, well, strategically, we still need to get the UK investing and therefore change the tax environment there might be the better strategic decision.
All right, Simon, got to leave it there. Brilliant to see you as ever. Thanks for joining me. We've got some breaking news for you now concerning the Premier League football club Brentford. It comes, of course, from our city editor, Mark Clement, who joins it now. Mark, what have you got?
Yes, Ian, another Premier League football club for sale. I understand that Matthew Benham, who first invested in Brentford in 2007, has hired bankers from Rothschild to sell potentially a controlling stake in one of English football's biggest recent success stories. Now, I understand that Mr. Benham values Brentford at potentially in excess of £400 million, a far cry from its valuation when he initially invested 17 years ago. Of course, Brentford has risen from the lower leagues to become a Premier League club now in its third season in the top flight. And, of course, we've seen a deluge of US money coming into the English Premier League in recent times. This will be another opportunity for US investors to buy into the top flight. Mr. Benham is open-minded about whether to sell a minority or a majority stake, but that sale process run by Rothschild will kick off, as I understand it, in the near future.
Great stuff. Thanks, Mark. Some other business news stories for you now. And HSBC has reported record annual profits despite an unexpected drop in earnings for the final 3 months of last year. Europe's biggest bank reported a pre-tax profit of $30.3 billion for 2023. That was up 78% on 2022, reflecting an increase in its net interest margin. That's the difference between what it charges borrowers and pays depositors. The bottom line was also boosted by cost reductions, a rising trading revenues and an increase in customer numbers, as well as a drop in the sum the bank put aside to cover loans it does not now expect to be repaid in full. However, during the final 3 months of the year, HSBC saw profits fall from $5 billion to $1 billion, following $3 billion worth of write-downs in China. The numbers were lower than the $34 billion expected by the market. Shares of HSBC have fallen by 4% so far this morning. BAE Systems said today it's sitting on a record order book as governments around the world step up their defence spending. The UK's biggest defence contractor said its order backlog had reached a record level of £69.8 billion after receiving orders last year of £37.7 billion. Well, that followed what BAE described as a number of significant awards, including work on submarines under the AUKUS agreement between Australia, the US and the UK. BAE also received big orders under the Dreadnought nuclear deterrent submarine programme and a number of orders for combat vehicles, including one from the Czech Republic. Underlying earnings for 2023 came in at £2.7 billion. That was up 9% on 2022. The shares are currently off, though, by 1.75%. Lower aluminium prices have hit profits at the mining giant Rio Tinto. The fifth largest company in the FTSE 100 reported underlying earnings of $11.8 billion for 2023. That was down 12% on 2022, thanks mainly to aluminium prices being 17% lower on the previous year. Prices of copper, diamonds and industrial minerals were also lower than in 2022, but the decline was partly offset by higher shipments of iron ore, Rio's single most important product. In our afternoon programme, I'm going to be joined by Rio Tinto's Chief Financial Officer, Peter Cunningham, so do tune in for that. And the BT Tower is to be turned into a hotel after being sold by BT. The buyer is MCR Hotels, the third largest hotel ownership and operating group in the United States, which has paid £275 million for the tower. Well, BT Towers opened for operations in 1965 by the then Prime Minister Harold Wilson, providing a number of network operations and broadcast services. But BT has migrated most of those activities to being delivered by other means. Now, Heathrow Airport has returned to profit for the first time since the pandemic, thanks to a bounce back in international travel. Its owners said today that underlying pre-tax profits came in of £38 million for 2023. That was against losses of £684 million the previous year, marking the first time it has made a profit since 2019. And I'm very pleased to say joining me now is Thomas Boldby. He's the new chief executive of Heathrow. Thomas, very good morning to you. Your passenger numbers, however, remain below pre-pandemic levels. When would you expect them to return to that?
Well, I think if we look at 2023, we can be really proud of the result. It was the third highest level of passengers ever coming out of the pandemic. I think that's a very respectable result. If we then look into 2024, I believe that we will, looking at the markets the way they look now, we will be exceeding the highest ever number in 2024 and coming in above 81 million passengers.
Well, that's encouraging to hear. I mean, arrival punctuality fell during the year. Which were the carriers at fault there?
Well, I think it's not so much about pointing at the individual carriers. It's very much about how do we get the entire ecosystem to work for our passengers and for our airlines. And if we look at January, in fact, our punctuality was back to where it was on average in 19. I think that's really an important milestone. And of course, we'll build from there to improve further.
One point that you make in the statement, which I thought was quite interesting, is that verbal and physical abuse incidents have increased during the year. What do you think is behind that?
Well, I think this is a trend you see, in fact, all over the world, that customers and passengers seem to be more ready to use abusive language towards the service employees that we have. And I think it's a trend we need to change because it's not fair to the people who do this work and who all put in a lot of effort to really make it pleasant for the passengers.
Are you doing anything around staffing to try and enhance the safety of your employees?
Oh, we do. This is primarily around training.
OK. Well, looking at the numbers, I mean, what struck me as being quite interesting is that passenger growth was pretty solid right across the route network. Obviously, transatlantic, though, remains the backbone of the business.
Yes, there's no doubt that the recovery, which at Heathrow has been faster than any other of the major airports in Europe, has been driven very much by the American market. But in fact, all markets apart from China are either on or above the level they were in 19. So that is a really sort of a strong base to start from. And we expect to see China coming back during 24 as well. So really, if you look at it, the bounce back has been stronger and faster than maybe we thought 2 years ago, and particularly for Heathrow now being the fourth biggest airport in the world and actually the best connected hub in the world has really sort of taken the lead in that.
Now, your 25% shareholder for OVR is looking to sell up, and that entitles some other shareholders to do so as well. How problematic potentially is that going to be for you?
I think if we see it from the management side, and I have to say that as management, we are not privy to the proceedings that's going on in that deal. From the management side, we really focus on delivering the best possible airport, both for our customers and for our shareholders. And I think that will be the focus of any shareholder we might have. So it's not really affecting neither the focus of management nor the any quality of service in the airport.
Now, this is the first opportunity we've had to speak to you since you took the helm. We spoke to your predecessor an awful lot, and he remained, even through the pandemic, very fixed on a third runway. How high is that up your list of priorities?
Well, I mean, the third runway is obviously, first of all, an enormous project that requires due attention, and we are giving it that. It is also a project that has enormous significance both for the entire country, for the company, for the airlines, and also for the society around us. And we need to give it that attention, and we owe it to all these stakeholders to take the right decision. We cannot rush a decision that size, and given COVID that sort of shook up the entire industry, we need to make sure that we reassess all the facts before we proceed, and also how we create capacity at Heathrow in the meantime, because there will be many years before the runway will actually be operating. So there are two strains to that work.
OK, Thomas, we have to leave it there. This is the first, I hope, of many conversations with you to come. Thank you for joining me this morning.
Thank you for having me. Thank you.
A bit of breaking news to bring you. The Foreign Secretary, Lord Cameron, has announced that the heads of the Arctic penal colony where the Russian opposition leader Alexei Navalny was detained will be banned from the UK and will see their assets frozen under new sanctions. The UK is the first country to impose sanctions in response to the death of Mr. Navalny last Friday. Well, last night's reverses on Wall Street were followed by mixed trade overnight in the Asia-Pacific region. Hong Kong and Shanghai continued to respond well to yesterday's key interest rate cut. Well, here in Europe, stocks are trading in largely to the downside, I think, again this morning. Actually, look at that. They're all in positive territory. There were one or two disappointing results from European companies today. Now, they include the German kidney dialysis specialist Fresenius Medical Healthcare. That is down 3.75% in Frankfurt. Meanwhile, the Dutch parent of Douwe Egberts Coffee, JDE Peet, is off 5.5% in Amsterdam. To the upside, Carrefour, the French supermarket giant, up 5.5% in Paris. It's raised its dividend this morning by 55%. Well, here in London, the FTSE 100 is definitely trading to the downside. I can tell you that, off 0.9% right now. That is largely due to weakness in HSBC. You'll note the FTSE's off nearly 69 points. Well, 40 of those alone have come from HSBC on its results today. That's off now nearly 7.5%. Another 7 points has been clipped from the index by the mining and commodity trading heavyweight Glencore. It's got full-year earnings out today. They've halved on weaker commodity prices. To the upside, the wealth manager St James's Place has risen by 2% on supportive broker comment, while Barclays, which we were talking about this time yesterday, rose by 8% yesterday on the back of its strategic update. It's up another 1.75% this morning. Outside the FTSE 100, Currys has risen by a further 2% as investors await bid developments, while the consulting and specialist engineer Wood Group is up some 2.5% nearly on a contract win. On the foreign exchange markets, it's pretty quiet ahead of the release of minutes later today of the Federal Reserve's latest policy meeting. Sterling more or less unchanged against both the dollar and the euro, likewise a single currency against the greenback. Meanwhile, the oil price rallied overnight, but it's been a bit drifty again this morning. Barrel of Brent crude will currently set you back $81.80 a barrel. That's off a little under 2/3%. Well, joining me now is Josh Mahoney. He's Chief Market... Oh, I do apologise. Josh Mahoney is not with us. Such a shame. There's a lot to talk about this morning. Anyway, we're going to have a short break. Coming up after that, are British businesses optimistic for the year ahead? We'll find out. Stay tuned.
And I'm Sky's correspondent based here in Washington, D.C.
Well, the plan seems to be to head to the police station where the policeman who fired the shots was based.
And everything, his memories is all gone.
I've witnessed the remarkable passion for politics here, but the anger too.
We have to get Trump out of the White House.
I'm playing devil's advocate.
You got your political agenda.
No, it's honestly...
God love you.
And beyond the United States, I report from around the world.
This is a town that is effectively encircled by the Russians.
We take you to the heart of stories that shape our planet.
I can hear now quite a few explosions in the distance here in Jerusalem.
What do you think of ISIS?
Everybody here, they know the truth of ISIS.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. British businesses are more optimistic about their profits and the wider economy than they were this time last year, but a majority are also looking to raise their prices by at least 6% this year. Those are among the main findings from the annual survey carried out by Boston Consulting Group, which spoke to 1,500 businesses last month. Well, joining me now to talk about this is Raoul Powell. He's the director of the BCG Centre for Growth. Raoul, good to see you again this morning. What do you put this rise in optimism down to? Is it all about interest rate expectations?
Well, I think that might be part of it. But I think when we look at our survey results, we see that business leaders are pretty optimistic about consumer spending. So I think 60% of the leaders we surveyed expect consumers to buy more of their products, and only 20% expect them to switch to cheaper products or lower value products. So clearly they think consumers will continue to spend. They're also quite bullish on the labour market. So 3/4 plan to maintain or increase their headcount, which I think runs counter to the expectations and forecasts around unemployment. So I think the combination of consumer spending, continued hiring, as well as what we see in the pickup in the data, PMIs, etc., with the economy getting a bit stronger, has all boosted this kind of optimism. But it is still from a low base, of course. We found that 50% or so of leaders still think there'll be a recession this year. So we shouldn't get carried away. But I think it does speak, as you said, to their pricing power and what their intentions are when it comes to inflation.
Yeah, that's quite surprising that you can be that optimistic and still expect some sort of recession.
Yeah, well, I think what we see is an interesting confluence of things here. Obviously, they will keep workers on, and that means wage pressures will continue. We see continued concerns about high energy costs and high input costs. While that's fallen off the narrative, of course, electricity prices for most businesses are still double what they were before the crisis, before the energy price shock. And we also see concerns around higher input costs, potential supply chain tensions. And so all of this together, I think, is creating that environment. And we also see both at the bottom end, businesses that are struggling with profits and have their margins squeezed wanting to make large price rises, and those at the top end who have seen profits thinking they can continue to make price rises. So all of this creates a confluence of pressure on prices, I think.
That's very interesting. I mean, you mentioned there that input costs are higher, so obviously businesses are trying to claw that back. But I mean, it kind of suggests that the companies you spoke to all feel that they have pricing power. They can set prices and consumers and customers just have to suck it up.
Yeah, well, clearly they think that the economy will be slightly stronger than expected this year and that there will continue to be that consumer spend and they will have the pricing power. I do think some are over-optimistic. You know, when we asked them about general consumer confidence, their numbers were a little bit lower, sort of around 50% rather than the 60%, thinking that it will be stronger. And so I think we do see that some are probably over-optimistic on their own outlook rather than the whole economy outlook. But clearly they think they have this pricing power, and that runs counter to, obviously, the inflation expectations. And I think the real question when it comes to inflation now is not whether it will hit target. It probably will come down due to base effects. But I think whether in the second half of the year we start to see it pick up again. And I think that puts the Bank of England in quite a difficult position.
Yeah, it's what the Bank of England itself is forecasting, of course, yeah. Now, when you carried out this survey last year, a lot of businesses flagged concerns about tightness in the labour market. Feels like that's still there.
Yeah, very much so. We've seen almost exactly the same results. I mean, last year we had 3/4 of business leaders saying they would maintain or grow their headcount. The same again this year. And I think, you know, if you look at the situation we were in last year, at the start of the year, we had forecasts of unemployment rising to 4.5%. We have the same thing this year. Last year, it turned out actually that unemployment barely moved. And so I think, you know, actually business leaders are signalling that they're going to continue to retain workers. And particularly in certain sectors, you know, we see acute skill shortages in, you know, finance, tech, in public sector in particular, health, education. And so the competition for workers and for skills is still pretty fierce out there.
Now, one of the other things that really jumped out at me, more than half of business leaders told you that the UK is the most stable political regime in the markets in which they operate. I mean, one wonders where some of these people are doing business.
Well, it's a big shift from last year. Last year, going into 2023, coming off the back of the Liz Truss budget, there was a lot of uncertainty, and we saw kind of that figure in the 30s, and now, as you say, it's up to 52. So it's increased by 14 percentage points. So clearly, even in a general election year, businesses feel whatever happens, there is some stability across the political spectrum. And I think that speaks to the environment being much more positive and does link to the more optimistic environment around growth.
Is that the fact then that a lot of business leaders quite like Rishi Sunak and his sort of more technocratic style, or is it that they think if Keir Starmer comes in, he's not going to frighten the horses too much and there won't be much change?
Well, I think it's probably a combination of the two, really, because whatever happens, it feels like businesses, know what they're dealing with. They seem to trust Rishi Sunak in terms of the stability he's brought and the consistency he's brought, but they're also not afraid of the prospect of Keir Starmer, and they continue to think that there will be, a growth and things will improve. And we asked up to 2026, and the optimism improves over the next few years as well. So I think the sense is, regardless of what the result is, businesses are broadly optimistic, although, of course, all of this is still within the context of the UK economy and a long-term malaise where, we do have quite low growth forecasts for the next few years.
Yeah, but worth pointing out, the political picture isn't particularly stable in other countries, most notably the US, of course.
Yeah, exactly. I think, look, this is a year where everyone goes to the polls. Has been well documented. We have so many elections across the world. So there is a lot of uncertainty out there in terms of domestic politics in different countries. You've then got the geopolitical uncertainty layered on, which businesses are still concerned about, potential supply chain disruption. So I guess relative, maybe the UK looks slightly better in that environment, but I think it does speak to an improved stability, and I think it does link to the improved optimism. So we shouldn't dismiss that entirely.
OK, Raoul, got to leave it there. Good to see you this morning. Thank you. That's it from me. I'll be back, of course, at 4:30 with our afternoon edition of Business Live. Hope very much to join you for that. Rio Tinto's Chief Financial Officer, Peter Cunningham, will be among my guests. Well, coming up next, Wilf is back for Prime Minister's questions. We're expecting a lot of interest in that botched cruise missile test that we've been learning about today. Stay tuned. Coming up after this break, it's PMQs.